cash, inventory, account receivable, and then we started with the current assets, and then long-term assets. And now we'll talk about the liabilities. First, our today's lecture will end up by accounting for, or by learning till current liabilities. Long-term liabilities we'll talk about next time, because it has a little bit, more numerical, things attached to that. Okay, so first of all, how we account for current and contingent liabilities. So let's just talk about first. So current liabilities and contingent liabilities. So there are two kinds of current liabilities. Number one, the current liabilities, which is, with known amounts, in which we know exactly that how much we have to pay back the money, how much we have to pay to the suppliers, how much we have to pay for the salaries, how much we have to pay the taxes, right? We already know the numbers. So definition is the same. The current liabilities whose life is less than 1 year or less than the accounting year. That's it. If the accounting year is more than 1 year, then less than the accounting year, right? Now question arises, what is the current liabilities with estimated amounts? For example, warranty payable, which has a condition, which has a contingency, or natural disasters. If something happens, then we have to pay to our employees something, some value. It has estimated amount, right? So for example, warranty payable. So we don't know how many, customers are claiming the warranty, but we have some kind of estimate, right? From our history, from our competitor, we see that, okay, these, 1% or 2% will, go for warranty, but we don't know the amount, exact amount, right? So that's why there are two types of current liabilities, with known amounts, with estimated amount. So current liabilities with known amounts include payroll liabilities, accounts payable, short-term notes payable, sales tax payable, accrued liabilities, unearned revenues, payroll, current portion of long-term debt. So I'm not going to explain that because we already have explained all the accounts here. What is unearned revenue? What is accrued liabilities, right? So just to talk about its treatment. First of all, accounts payable, how we are going to treat them. What is account payable? Normally, this liability aroused when we purchase our inventory, or when we purchase raw material or services from our supplier. So this is very common transaction, and it is for normal business operation, buying, selling, buying, selling. So we buy a raw material or we buy inventory, and then we sell to our customers. Very common transaction. So accounts payable turnover is an important measure for the liquidity. So this is basically for finance purposes. So we are not going to spend more time here, just to give you the taste here, and that is, it is a liquid. It is a measure of liquidity. Why? Because you have to pay them in less than 1 year, and how quickly you can pay them is called the liquidity. So if you are paying your accounts payable twice a year, thrice a year, or 4 times a year, it means your liquidity is high. So this is a finance terminology. We will, if you happen, get the chance to have a finance course, then I would be explaining over there. Okay. So right now, account for the accounts payable. So we already done that. A number of questions we already talked about. Here we go. So we are not going into the turnover stuff, okay? Just for your, knowledge, and that's it. And for your, to quench the thirst of your knowledge, and that's it, because this is not the accounting purpose, this is for finance purpose. We don't make any entry regarding this turnover stuff, okay? So how we are going to treat them? Simple. We purchase supply from our suppliers. Entry, you already know that. Supplies to account payable. Simple. So similarly, the short-term notes payable, how we are going to account for? Short-term notes payable. Similarly, its life is less than 1 year. The notes payable, I already explained you over there that notes receivable and notes payable, right? Stuff is the same, just one thing. In notes receivable, you need to receive cash based on some terms and conditions. In notes payable, you have to pay after some time plus the interest as well. In notes receivable, you receive the interest. In notes payable, you pay the interest. Simple. So let's talk about the example here. So the following entries cover the purchase of inventory costing 8,000. Accrual of interest expense and payment of a 10% short-term due in 1 year. So first of all, you purchase inventory through notes payable, 8,000. So did you pay cash? No. Your inventory increase because you purchase inventory. Inventory increase debit, liability increase credit. So it's going to be inventory to notes payable, short term. That's it, 8,000. Right? Now after 1 year, you need to pay 10% interest. So interest expense to cash, if you pay within year, if you didn't pay, then it's a liability, interest expense to interest payable. But since it's a short-term liability, it's going to be. So question says that the company fiscal year ends on September 30, right? Company accounting year ends at September 30. So it means the interest is due on at the year end. The company must accrue interest expense at 10% for the January through September. So 9-month interest is accruable. Accrue means interest occurred, expense happened, but not paid. When not paid, liability increases. So interest expense to interest payable, because we didn't pay cash, we will pay after 1 year. We are now at 9 months. After 1 year, we will pay. So after 9 months, because September accounting year closes, so matching principle apply. You know, the expense of, of that period will be recorded in that period. So till the September expense going to be recorded. So we create a payable account. So finally, when you pay that, so simple, you decrease the you decrease the liability and the cash and the interest expense as well. So notes payable you pay back, decrease the liability. Decrease in liability means debit, and you pay cash. How much you pay cash? 10% on this one, 800. So total amount you paid 8,800, in which 800 was the interest, right? 600 belongs to previous year, so expense already recorded over there, only payable. So we just decrease the liability, and this period interest is only for 3 months. That's it, 200. So this is just treatment is the same. It's just we are revising it on current liability on balance sheet wise. That's it, right? So you understand this entry? Ella, Marilyn, Nam, Pinyo, Anthony.
Yes.
Good. Next, sales tax payable, simple. So sale tax is basically levied on retail sales, when you sell to the end user customers. So we have illustration here, simple. So the sales at a Home Depot total 200,000, all in cash. Home Depot collected additional 5% of sales as the tax. The store would record the day sales as follows. So they received the cash, how much? 210,000. Additional, not inclusive, additional, which means 210,000 they received the cash. The cash received 210,000. Their sale is 200,000. The cash to sale, the entry is not complete. So which means 10,000 is sales tax payable. Simple, right? Similarly, accrued liabilities, which means expense occurred but not paid. When not paid, we create liability. For example, salaries, interest, we just did the entry for interest payable and interest expense, income tax, right? So how we are going to treat that, we already know. We have done a number of examples here. So payroll liabilities, why we need this separate head, payroll liabilities? Why not we just call it accrued liability? In accrued liability, we have sales and wages payable. Why we need another payroll liability? So why? Because in some companies, employee compensation is a major expense. If you go to high-tech industry, their raw material cost is too high. Purchasing, iron, molding the iron, their utility bills are skyrocketing. But in some companies, for example, Microsoft, Apple, payment to employees are huge. So they want to see that whether how much they can control this cost. So in order to see that, they make a separate head. So all the salaries, wages, commission, bonus to employees will be recorded in this payroll, so that they can compare that, okay, how much we have paid to this year or this month as a payroll. If it's a minor expense, then you don't create a separate account, just salaries account, that's it, right? So in some companies, which is mostly human oriented, service industry, IT technology industries, over there salary and compensation part is a huge part, so we need a separate account, payroll account, right? Since this is accrued liability, it means you work in advance for them and then you will be paid. So for a company is liable to pay after receiving the work. So you work for company whole month, and after the month you will receive the salary. So that's why we create payable or current account. Current liability account here. So the example here is simple. Salary expense, because 10,000 you paid the salaries. Inside the tax, inside this 10,000, how much belong to tax? Tax belong to government, so tax payable. FICA tax payable, which is federal income tax, you have to pay on behalf of employee, 800. And how much in cash? You will pay salary to the employees, only 8,000. So employee will receive 8,000 cash as a salary, but not received yet. In addition to 8,000, this additional 2,000 is the employee income tax and federal income tax, right? So that's why we need a separate payroll. Sometimes we want to see that whether, like in China, the tax rate on foreigner salaries are huge, right? So they want to see that how much we are paying to the government, how much we are paying to this person, how much we are paying with the pension, right? With their some other benefit funds. So this is how we create a payroll. But remember, payroll account is established in that country, in that company whose compensation to the employees part is